Welcome to Talk Tickers. You're looking for those critical insights from earnings calls. You know, the stuff that really matters boiled down fast.
Exactly. And today we're jumping into Halliburton's first quarter 2025 call.
Right. Our mission, as always, is to unpack the key financials, the strategic moves, and really figure out what it all means for investors like you.
Okay, let's hit the highlights first. Total company revenue for Q1, $5.4 billion.
And margins.
Adjusted operating margin came in at 14.5%.
Okay.
Now, international revenue was $3.2 billion. That's actually down 2% compared to last year.
Down 2%. Why was that?
It was mostly about lower activity down in Mexico, if you actually pull Mexico out of that number.
Oh, okay.
International revenue actually grew, mid-single digits, in fact.
Interesting. So Mexico was a significant drag. What about North America then? That's always a big focus.
Yeah, North America revenue hit $2.2 billion. That is a drop 12% down from Q1 last year.
12%. Wow.
But despite that, cash flow looked okay. They generated $377 million from operations. And free cash flow was $124 million.
So still generating cash even with the lower revenue.
Exactly. And they kept sending cash back to shareholders too, bought back about $250 million worth of common stock in the quarter.
Okay. So, like you said, a bit of a mixed bag on the surface. Let's dig into the context. What were they saying about the broader market?
Well, they definitely talked about the macro environment, uncertainty around trade, some economic jitters floating around.
Yeah, it tracks.
And of course, OPEC production affecting oil prices. But Halliburton's view seems pretty firm. Oil and gas are still fundamental.
Right. Demand keeps growing globally.
Exactly. And they emphasize something crucial, those natural decline curves in existing fields. You have to keep investing just to keep production flat.
You can't just rest on your laurels.
Not at all. So their strategy really leans on, technology, collaboration with customers, and just solid service quality. That's how they plan to differentiate.
Makes sense. Focus on what you can control.
Okay, let's zoom back in on those international markets. Revenue down slightly overall, but up excluding Mexico. What's the outlook there?
So yeah, $3.2 billion internationally for Q1 is pretty solid. But looking ahead for the full year, they're a bit more cautious now. They're expecting international revenue year over year to be maybe flat, maybe slightly down. They mentioned embedding a bit more risk into their outlook.
Okay, more uncertainty baked in.
Right. But it wasn't all caution. They said Q1 international tender activity was actually really strong. Lots of potential work coming down the pipe, stretching beyond 2026 even.
Any big wins they highlighted. It always helps to have concrete examples.
Absolutely. They mentioned Shell specifically. Big contracts in Brazil for the Gato Diato development.
Okay.
That includes intervention work, plus exploration stuff with Shell and Serenam in West Africa.
Serenam seems to be popping up more.
It does. They also landed another big integrated offshore exploration deal there with a different major operator.
And this ties back to their tech focus, I assume. Definitely. They pointed to things like their intelligent completions helps optimize wells remotely. The iCruise and Logix is drilling automation system.
Right, for efficiency.
And their remote operations platform. It's all about using tech to deliver better results.
Got it. So tech's a big lever internationally. What other growth areas did they mention outside the U.S. and Canada?
Yeah, a few key ones. Unconventional plays, think shale gas, tight oil, that's a focus. They actually shipped their Zeus electric frack gear to the Middle East for trials.
Electric fracking in the Middle East. That's interesting.
It is. Then there's artificial lift methods to boost production from older wells. They've got new offshore work in Ghana, expecting strong double-digit growth there.
Okay.
Intervention services, especially deep water stuff, boosted by that Opime Subsea acquisition they made. And directional drilling, they deployed their first closed-loop automated drilling system in Norway and the Middle East.
Fully automated drilling. Wow.
Well, closed-loop automated, it uses feedback to adjust itself, a big step.
Okay, let's pivot back to North America. Revenue down year over year, but you said it was up slightly from Q4. What was going on there?
Yeah, that 1% sequential bump was mainly seasonal. Fracking activity picks up a bit after winter.
Right, weather clears up.
That increase just managed to offset weaker completion tool sales, particularly in the Gulf of Mexico.
And what's the feeling among customers there? Are they locking in plans for next year?
It sounds like customers are still figuring out their 2025 activity levels. Halliburton mentioned the potential for maybe more idle equipment, what they call white space, or even fleets being retired or shipped overseas.
So some uncertainty there too. But Halliburton sounds confident they can do well regardless.
They do. They express confidence they'll outperform the overall North America market.
Why is that? What gives them that edge?
A few things. They keep talking about their value maximization strategy, focusing on profitable work, not just chasing market share.
Makes sense in a tougher market.
And a big chunk of their frack fleet, over 40% now, is running on term contracts using that Zeus electric technology. That gives them some stability.
The contracted Zeus fleet.
Exactly. And again, technology differentiation. They even mentioned Secretary Bergam visiting a site in Pennsylvania, checking out the Zeus E-Fract gear.
Highlighting the tech, yeah.
Yeah.
And speaking of Zeus, what about that autonomous fracturing Zeus IQ?
Right. That was a big announcement. They completed the world's first successful closed-loop autonomous fracturing operation using Zeus IQ.
Autonomous, so no human intervention during the actual pumping.
Essentially, yes. It uses real-time data from the reservoir to control the water and sand placement automatically. They see it as a huge leap in efficiency and getting more oil and gas out.
That sounds potentially revolutionary for fracking.
It could be. So yeah, North America focus, returns, managing equipment smartly, and investing in safety, service quality, efficiency, and obviously rolling out tech like Zeus IQ.
Okay, let's get into the nitty-gritty financials then. We heard the top line numbers, but what about the bottom line, the divisional stuff?
Okay. Reported net income was 24 cents per share, but their adjusted net income, which smooths out some items, was 60 cents per share.
60 cents adjusted.
Total revenue, like we said, down 7% year over year. Adjusted operating income landed at $787 million, giving that 14.5% margin.
Right.
But there was a big pre-tax charge this quarter, $356 million. That covered severance, writing down some asset values, and adding to reserves for old environmental issues.
Ouch. A significant charge.
Yeah. They said ongoing cost-cutting efforts should help support margins going forward, though.
And how did the two main business divisions perform individually? Completion and production first.
Right, C&P. That includes pressure pumping, completion tools, etc. Q1 revenue there was $3.1 billion, down 8%. Operating income took a bigger hit, down 23% to $531 million. That put their margin at 17%.
Why the bigger drop in income?
Mostly that slowdown in pressure pumping activity and lower completion tool sales, especially in the Western Hemisphere.
And the outlook for C&P in Q2.
They expect revenue to tick up sequentially, maybe 1-3%, but margins to be roughly flat compared to Q1, and that includes absorbing some impact from tariffs.
Okay. And the other division, drilling and evaluation.
D&E, that's drilling services, logging, evaluating the rock. Q1 revenue was $2.3 billion, down 6%. Operating income, $352 million, down 12% for a 15% margin.
What drove that decline?
Primarily less activity in Mexico, which we talked about, and also in Saudi Arabia during the quarter.
And the Q2 forecast for D&E.
They see revenue flat to maybe down 2% sequentially, and margins are expected to dip by about 125 to 175 basis points.
Why the margin dip there?
Couple of things. Seasonally lower software sales, which are high margin, and higher costs for mobilizing equipment to start new projects.
Got it. But is that dip temporary?
They think so. They expect margins in Q3 and Q4 to get back closer to the levels they saw in the second half of last year, 2024.
Okay. Any other geographic highlights or lowlights?
Yeah, a quick run through Europe. Africa was actually up 6%, places like Norway and Namibia doing well.
Good to see.
Middle East Asia also up 6%, led by Kuwait and Saudi Arabia. Despite the Q1 dip in Saudi activity mentioned for D&E, overall growth was positive for the region. Latin America, though, down significantly 19%. That's Mexico pulling it down hard.
Right.
And North America, as we discussed, down 12%, mainly U.S. land fracking and Gulf of Mexico completion tools.
Okay. Any other financial bits and pieces investors should be aware of?
A few quick items. Corporate expenses were $66 million. Expect that flat in Q2. The SAP software upgrade costs about $30 million. Also expected flat. Net interest expense was $86 million. Expect that to tick up maybe $5 million in Q2. Same for other net expense, $39 million in Q1, maybe up $5 million next quarter.
Tax rate, CapEx.
Normalized tax rate was 22.1% in Q1. They're guiding to around 23% for Q2. Capital spending, $32 million in Q1, but for the full year, they expected around 6% of revenue.
And did they quantify the trade situation impact? Tariffs and such?
They did. They estimate it'll hit earnings by about 2 to 3 cents per share in Q2. And importantly, that's already baked into their guidance.
Okay. Good to know it's factored in. So, wrapping up the guidance, what's the overall message?
I think the main theme is just more uncertainty out there compared to 3 months ago. That's clear.
Yeah. Seems to be a common theme this quarter.
But despite that, Halliburton sounds confident they can execute their strategy. They expect international markets to keep outperforming relative to the broader market, winning more work.
Yeah, North America.
They expect to outperform there too, leaning on that Zeus IQ tech leadership and the contracted fleets providing a base.
And cash flow, shareholder returns.
Still projecting solid free cash flow for 2025. And they reiterated being on pace to return at least $1.6 billion to shareholders this year through buybacks and dividends combined.
Okay. Now, thinking about the investor perspective, what sense did you get from the call about customer mood, especially in North America with prices bouncing around?
Yeah, there was definitely talk about customers being a bit cautious, watching commodity prices closely. That impacts decisions on rig counts and completion activity.
Understandable.
Regarding Mexico, the message was, yeah, it's tough now, but the geology doesn't change. Decline rates mean activity will have to come back eventually.
A matter of when, not if, maybe.
Kind of. And for Saudi Arabia, despite that Q1 D&E dip, the overall outlook within Halliburton's portfolio there seems strong. Big opportunities, especially in unconventional gas like Jafurah, plus intervention and artificial lift.
And they explained the margin ups and downs pretty clearly.
I think so. Explain the Q2 dip in D&E margins from tariffs and mobilization costs, but also reiterated the expectation for recovery in the second half back towards H2 24 levels.
Any other interesting tidbits that came up?
Well, they talked about increasing their stake in Voltagrid, that power solutions company, shows they're interested in the power side of things, though they stressed a measured approach.
Diversification potentially.
Maybe, or adjacent services.
Yeah.
They also reinforced their commitment to share buybacks as part of using free cash flow, and touched on the positive long-term view for natural gas activity driven by power demand and LNG exports.
And one last thing, how do they feel about their position offshore this cycle compared to past ones?
They sounded quite positive, actually. Emphasized how much their technology has advanced, making their offering much stronger for offshore operators now compared to previous cycles. Better value proposition, essentially.
Okay, makes sense. Right, let's shift gears to our This Is Not Financial Advices segment. Time for some outrageous but plausible trade ideas based purely on today's discussion. You first.
All right, so Halliburton sounds really bullish on international growth, especially artificial lift. They mentioned double-digit growth expectations, new work in Ghana.
Right.
So here's a thought, purely speculative. Maybe look at going long on some oil producers heavily focused on offshore West Africa. The idea is, if Halliburton services boost their production like Halliburton hopes,
then those producers can become more profitable.
Exactly. Highly dependent on Halliburton executing, no disruptions, all the usual caveats, very speculative.
Okay, interesting angle. My turn. I was struck by the Zeus IQ autonomous fracturing buzz. Halliburton sees it as a game changer, expects customers with long life assets to adopt it. So how about a paired trade? Go long companies that have big positions in North American unconventional plays, the ones with assets that could really benefit from squeezing out more oil and gas efficiently with tech like Zeus IQ.
And the other side of the pair.
Maybe short companies focus more on short cycle, conventional wells, the kind that might be slower or less incentivized to adopt this kind of advanced, potentially pricier tech upfront.
So betting on a technology adoption divide.
Pretty much. Assuming Zeus IQ lives up to the hype and really does create a competitive advantage in those unconventional basins. Again, totally speculative.
All right, that brings us to the end of our deep dive on the Halliburton Q1 2025 earnings call. We've tried to hit the key info you need.
And just to reiterate, everything we discuss comes from the call itself, and it's for informational purposes. That last segment. Purely speculative ideas? Definitely not financial advice? Always do your own homework before making any investment decisions.
So what stood out most to you from this call? What questions do you still have? Keep thinking, keep digging.
Thanks for tuning in to Talk Tickers. Join us next time for another earnings call breakdown.